Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week we're covering California's treatment of Trump accounts and contributions. For a deep dive into these new accounts, attend Spiedel's one-hour webinar on February 2nd, The ABCs of Trump Accounts. For details and to register, go to spiedel.com and click Webinars. And as we do each year, this podcast will be on hiatus through tax season, and you'll be receiving Spiedel's Tax Season Tribune, which is a short weekly newsletter that has lighter fare than our regular content. The podcast will resume for its 11th season on April 19th. Because California conforms to the Internal Revenue Code as it read on January 1st, 2025, California does not generally conform to the changes made by the One Big Beautiful Bill Act. However, California does have some provisions related to retirement accounts where we automatically conform to any federal changes. This has generated questions about how California will treat Trump accounts, which are enacted on July 1st, 2025, and are defined as a type of traditional IRA under IRC Section 408. We reached out to the FTB to confirm how they'll treat Trump accounts and contributions made to these accounts. Trump accounts are established pursuant to IRC Section 530 Cap A. Even though Section 530 Cap A states that Trump accounts are Section 408 subsection A IRA accounts with specific modifications, the FTB is taking the position that because California does not conform to Section 530 Cap A, Trump accounts will not be recognized as tax-deferred accounts for California tax purposes. This means that earnings on these accounts will be taxed by California annually, not when distributed. However, remember that these accounts are the child's account, not the parents or other guardians. This means these accounts are similar to a Uniform Transfers to Minors Act account or UTMA account, so the kiddie tax rules apply. California does not conform to the new IRC Section 128 exclusion for employer contributions to an employee's Trump account established for their child or children. According to the FTB, these contributions are taxable income to the employee. California also does not conform to the IRC Section 139 Cap J exclusion from gross income for qualified contributions from tax-exempt entities like the Dell's Charitable Fund or state, local, or tribal governments. We asked the FTB whether these contributions might be treated as non-taxable gifts or qualify for the general welfare exclusion. The FTB stated that it is, quote, not aware of any federal guidance that would expressly exclude these payments from gross income under either IRC Section 102 or the general welfare doctrine. Absent such guidance, these payments would generally be considered income under California's conformity to IRC Section 61, end quote. Because these contributions are placed in the child's Trump account, if indeed taxable income, Spiedel believes that this would be taxable income to the child and not the account's custodian. Finally, regarding the treatment of the $1,000 pilot contributions for children born in 2025 through 2028, the FTB states that, quote, California would treat the $1,000 pilot contribution as gross income, and the individual would be required to make an adjustment to add back the contribution as income for California purposes, end quote. However, because this contribution is placed in the child's Trump account, we question whether this is income to the parent or to the child. Either way, if the $1,000 is subject to tax, it would create basis in the account for California tax purposes. The bottom line is that California will treat all contributions into a child's Trump account as taxable and will treat all earnings as taxable income annually. This means that once the Trump account's growth period ends around the child's 18th birthday and the account is automatically converted into a traditional IRA, the account's California basis will be equal to the fair market value of the account at the end of the growth period. These issues are far from clear. However, because none of these issues really come into play until the 2026 returns are filed, the FTB and tax professionals will have a year to sort through them. Stay up to date with California nonconformity issues with a subscription to Spiedel's California Tax Letter, a monthly newsletter written by California tax pros for California tax pros. You can get details and download a sample issue at spiedel.com under Publications. That's all for this week. Have a productive tax season, and we'll be back in April.